Kia ora, I'm Nadine Higgins and welcome to your personal finance podcast, The Prosperity Project. On this podcast, I'm on a mission to empower you financially. I am a columnist and a journalist, an investor, a financial advisor, and the mum of a toddler. But I do not claim to be the font of all knowledge. I'm still figuring it out too. And that's why I'll be bringing you the experts and mining their big brains for all the things you and I need to know every week. When the US President Donald Trump announced a pause on tariffs, prompting a massive rally on the markets, he admitted that he did so after watching the bond market. So why is the bond market so significant, and what do you need to know about how it works, especially given you likely own some bonds in your KiwiSaver fund? Joining us now from Fisher Funds is Matt Logan. Kia ora, Matt.
Kia ora.
I want to ask you about Trump and why he was looking at the bond market, but I thought we might just start by taking a quick step backwards first, starting with the basics. What are bonds and how do they differ to shares?
Yeah. Great question, and a very important one and a timely one, as you say. So bonds in their simplest form is usually just a government or a company borrowing money. And so with a stock, say Microsoft stock, you can, purchase that and you will sort of see the share price go up and down, perhaps with dividends or the earnings trajectory of that business. Bonds are a much more simple and frankly, most of the time, more boring instrument where Microsoft might, maybe they want to buy TikTok, for example, and they'd rather use debt to fund that than cash on the balance sheet. They might look to the bond market to raise that. And so they can go out there and borrow money, essentially. And so most of the time, they're relatively sort of low risk and in the background, I guess. But yeah, from time to time, they do sort of hit the headlines.
We'll talk a bit more about whether they're boring or not in just a second. But what you're saying is that I, as an investor, or you, as an institutional investor, lend money to a company or a government at an agreed interest rate for a fixed term. Is that a fair assessment?
Yeah, perfect. And I guess the only other wrinkle compared to shares as well is there might be a lot of bonds. And so maybe Fisher and Paykel might want to do something and they borrow money for 3 years because it sort of suits their time frame for what they're doing. And the New Zealand government might have a really long infrastructure bill planned and, want to look decades out with that funding. And so they may issue 30-year bonds. And so there's a little bit more complexity, I suppose, as well with bonds. But yeah, at its basics, it's just borrowing money for an agreed amount of time for an agreed interest rate.
But over that period of time, the price of the bond can change. And as I understand it, that has an inverse relationship to the yield or the interest rate. How does that work?
and this is where the conversation usually starts leading to furrowed brows and note-taking. Yeah, at its heart, it's not too complicated. So say I was to lend you $100 at 5% interest today, and it seemed like a pretty fair deal, and we were both happy with that. But then, next week, the RBNZ reduced interest rates. And in fact, they reduced them by 2% because all of a sudden there were lots of concerns about the economy. And so the Reserve Bank dropped interest rates massively. I'd probably be feeling pretty good about that 5% now. Because if I tried to do the same thing again, you might say, well, no, maybe today it's 3%. And so bonds adjust for this. There's a market for bonds traded on the secondary market, just like shares. And so the mechanism is priced just like a share. And so what happens in that case is the price of that bond would go up. And then the yield is the concept that would capture the fact that the rate of interest you would receive from then on would be lower. So yeah, price goes up, yield goes down.
Okay, that's actually the best explanation I've ever heard because I found that quite confusing and I'd like to think I'm not alone. So let's start talking about the current situation and why, when the share market was tanking, the US president was looking at the bond market.
That's right, yeah. And normally when shares tank, the US government bonds, which is the ones he'll be looking at for sure, the yield on them goes down. And it's a flight to safety. You might have heard those sort of words before. And that's as investors rush into government bonds to sort of have some security when, other parts of the market are super volatile. What caught President Trump's eye was that the yield on bonds went up. And so the price of bonds went down, which is unusual to happen when markets are volatile. And so the reason that caught his eye is because he borrows money at that rate. So when the yield goes up and you've got a big budget deficit and you need to borrow money, nothing is going to get a president's eye more quickly in the eyes of everyone around him, from the Treasury to the Fed, than if the yield on those US Treasuries starts going up and the cost of borrowing starts going up. That got his attention real quick.
So effectively, what's happened is his own policies were making his own government's borrowing costs more expensive, and that was a problem.
Yeah, absolutely. And one of his stated goals from the Department of Government Efficiency, as well as tariffs, has been to get the budget deficit in line and to move the US economy and government towards sustainability. And one of the absolute key factors in that is how much it costs to borrow money.
Does it have implications for borrowing costs for us? Because I see it quoted all the time, what US 10-year treasuries are doing. Is there significance because we're a country that does a lot of our funding from overseas?
Yes. And so just like the trade of goods across the world, financial markets are also highly interconnected, and sort of, fund managers and portfolio managers across the world are looking to different parts of the world to make investments. And so, the short answer is yes. So when the US Treasury rises, most of the time, so does New Zealand government bonds, and so do Australian government bonds, and the UK and Germany and the other sort of countries that we would normally look at. And even more than that, when the US Treasury moves, the share market worries too, because they're the biggest borrower in the world, and that rate kind of underpins the foundation of all sort of capital markets.
Without wanting to get too much into geopolitics, it's sort of, you can't really escape it with this particular topic, but China owns a lot of US government bonds, right? So how does that fit into this matrix of the trade war that's going on?
Yes, well, no, it's a perfect question, because a trade war can be fought across many fronts. And while it would just be speculation, I would be surprised if China wasn't using that as a mechanism to exert leverage on the president and his sort of proposed tariffs. So, the US government runs a huge budget deficit, they need to borrow a lot. The US economy can't support all of that, so they borrow a lot from offshore, and none more so than China.
How would they use that as leverage?
They stop buying the bonds, basically. And so I don't have the numbers at hand, but it would boggle your mind how much the US Treasury has to borrow every week. It's in the tens to hundreds of billions. And so it doesn't, if your number one buyer stops showing up at the stall to buy your bonds, the price is probably going to go up to entice other people to buy them instead. And so, again, I don't know. I'm not plugged in, but it would be a sort of pretty rational thing for the Chinese government to put pressure on the US administration.
So you said that the bond market is usually quite boring. How would you describe the current conditions then?
Yeah, anything but. While exciting in some ways, I wouldn't mind a return to a bit more of a boring market, to be honest. It's during times like this that the bond market really comes to the fore. When market volatility is sort of, I guess, rearing its ugly face, that's when people care about the bond market. Because I guess, I alluded to before, but bonds forming a kind of foundation of capital markets. When the foundation is cracking a little bit, the whole house shakes. And so people really do get worried when the bond market isn't working. At Fisher Funds in the investment team room, it's worrying when people come over to talk to us in the bond team about what's going on.
Are you normally the ones in the corner that no one's asking questions of, are you?
Exactly. And so that has been happening a bit more recently. So hopefully for all of our sake that returns to normal soon.
So you talked about bonds being like a safe haven asset. Are they still? Or are they only a safe haven asset in normal times, and these are not normal times?
It's a good question. And these are the questions that get asked and get kicked around when volatility really spikes. cast my mind back to, I want to say late March 2020. And that was another market characterized by extreme volatility. In fact, there was one day where we needed to sell some bonds to raise liquidity. And US Treasuries are the most liquid investment in the entire world. And we couldn't sell any that day because of the amount of volatility that was happening in markets. And so people were saying, well, something's broken. What's happening here? This coronavirus pandemic, it's done something to markets we've never seen before. Do we need to sort of throw the baby out with the bathwater and just start from a fresh piece of paper about how markets work? And that's going to be my answer 99 times out of 100. So for me, I think you need to see prolonged periods of, genuine shifts away from certain asset classes before I'm going to rewrite some of those rules. So I guess the short answer is no, I don't think bonds have lost their safe haven status. But hey, happy to be challenged on it. And it's certainly something we think about a lot.
Because I guess the way most Kiwis would interact with bonds is that they would have them as a part of their managed fund in KiwiSaver, particularly if they're at that kind of balanced conservative end of the market, right? But if they're not behaving the way that conservative assets normally behave, anyone who's coming up to retirement or about to need that money is probably really worried about that because the conventional wisdom that they've been told doesn't feel like it's holding true.
Yes. And so it's worth putting this all into context. So when the bond market sort of goes through a bit of turmoil, we're talking maybe 0.5% to 1% to 2% moves. And we're not talking 8% in one day moves like you'll see in the share market, or 20 to 30% drawdowns from peak to trough. So it's relative, I guess, to normal moves. Last week we saw a one-day move that was pretty significant, but in the 3 to 4 days prior to that, the bond market was sort of performing as expected. So actually prices were about flat across that. It's just that when things happen that are really unusual, when charts have a nice little vertical line, everybody loves a chart and they all just kind of focus in on that and just say, please explain what is going on. But no, so this is all within the sort of expectations, I guess, for volatility. And hopefully most, particularly conservative and balanced investors, are not looking at the prices of their portfolios every day. Monthly is probably too much.
We talked about just that point last week with Mary Holm about people looking at their KiwiSaver too frequently, and that comes home to roost in times of volatility. And context was a very good point that you made. We're going to take a quick break, but when we come back, we're going to talk about investing in bonds and how you go about it. Back after this. Welcome back to the Prosperity Project. We're talking about bonds after President Trump said that he was looking at the bond market before he made the announcement that he was going to pause tariffs. But I want to talk about this, Matt, from a more individual level. As an individual investor, set aside that I probably own some in my KiwiSaver fund. If I wanted to just buy bonds, cherry pick the ones that I wanted to buy, how do you go about that? Is it as straightforward as it is when it comes to buying shares from the share market?
The short answer is no, which is a bit unfortunate because they are pretty simple instruments and relatively low risk. So you'd maybe expect them to be easy, but so you can. There's the NZX, which everyone's probably familiar with, which lists shares. And then there's the NZDX, where the D stands for debt. So a bond is a debt instrument. And so there are bonds that are listed on there and you can go on and buy them. So that would be one way. And some Kiwis do like to invest that way. But it is pretty tricky. The majority of money in New Zealand that's invested in bonds would be through, managers such as Craig's or Forsyth Barr, or through Fisher Funds or Milford and asset managers like that through a bond fund. Probably one of the easiest ways would be to buy an ETF. ETFs for stocks are pretty well known. There's also ETFs for bonds. I think there are some of those on Sharesies, so that would be a pretty easy way for everyday Kiwis to get exposure. But the tricky part about bonds is that because they're sort of all bespoke, might have a company. So Spark, for example, they don't just have one bond you could go out there and buy at a fixed rate. They'll have a few New Zealand dollar bonds. They might have some that are listed on the NZDX, some that aren't. They've got some Australian dollar bonds. They might issue in euros even. So, yeah, that sort of, I guess, it's a bit niggly. It makes it a little bit more difficult for mums and dads and kids to go and buy them directly.
And presumably as an individual, you also need to be doing that weighing up between what's the prevailing interest rate, what's the price of the bond, what's the yield. And that all just seems quite a complicated equation. Is that something that you guys are using, some sort of calculus to work out the right point? Because it seems beyond your average investor.
Yeah, so bond math. That could be a whole.
Yeah.
We could do a 2-hour podcast on that if you'd like, and all three listeners would love it, I'm sure. No, so most retail investors and I'd sort of, mums and dads class as retail investors, they would probably buy a bond near or at when it was issued, and then just hold it and then get the money back at maturity. And so, thinking about checking prices of things, but they just don't check the price. And if the bond is for 5 years, they just keep it there in their portfolio, clipping their 5 or 6%, and then get their money back at the end, which is actually a great way to go about that investing. Yes, the price of the bond is going to change over that 5 years. And absolutely, yes, if interest rates were to go up or down in a meaningful way, you might want to look at that and sort of either sell or buy some more. And for sure, if you've lent money via a bond to a company and that company's looks like it's going to run into trouble, then 100% you want to sell that bond, because bonds can default, particularly ones raised by riskier corporate issuers. It's actually not such a bad thing to just buy a bond and put it in your back pocket.
So does that make them a pretty good alternative to a term deposit? If you had been a conservative investor who just wants to put their money somewhere safe that's maybe going to pay them quarterly interest or whatever it is, would you just look at buying a bond when it's issued and holding it for whatever the term is and collecting your interest?
Yep. And a term deposit is very similar to a bond as far as how it works and how retail investors should think about it. The nice thing about a bond is the term deposit, the deposit rate you can get on a savings account changes, whereas for a bond or a term deposit, it's fixed for whatever you lock it in. The income is taxable in both cases as well. It is very similar. I guess the one thing that, there's lots of differences, but you can sell a bond at any time. So that is a bit better than if you've, got a 5-year term deposit and you want to break after 2 years, say.
And would you get any better interest rate out of a bond than you would out of a term deposit? Because I guess that's what particularly maybe retirees are looking for at the moment, while their income has dropped so sharply amid the fall in interest rates, is where else can I put it to get a reasonable return that's not risky?
Yes. And unfortunately, the old adage, there's no free lunch, definitely applies. So you will take on more risk if you want a higher return. But you probably will get a slightly higher return, particularly from a corporate bond than you would from a term deposit. Now, the inverse is actually true. If you were to buy a New Zealand government bond, you would probably get a lower rate than if you had it on term deposit. And that just reflects the fact that lending to the government is seen to be even less risky than putting your money in the bank.
Right. So there's a real difference here between a corporate bond, so to a company, to your Spark or your Fletcher Building or one of the banks or whatever, and the government. Because, I don't know, does everyone make the assumption that whoever is big enough is kind of backstopped by the government anyway? Yes.
So again, the bond market starts to become a little bit less simple when you delve into this. So the credit rating, you probably have heard of S&P or Moody's, and they issue credit ratings. Most bonds you'll see will have a credit rating, and AAA sounds great, and it is, and that's what the New Zealand government is rated. But as you go down the spectrum, you will tend to get paid more and higher interest for bonds issued, and they go all the way from AAA down to single A, then triple B and double B and single B, and then into the C's as well. And if you're in real trouble, into the D's. But D stands for default, so you definitely don't want to be there. In the New Zealand market, anything on the NZDX generally rated BBB to AA. So your banks are in the sort of AA, single A area, and Spark is currently single A. And so you get paid more for bonds issued by those. But yeah, for the New Zealand government, AAA, you get paid basically just the prevailing interest rate. And the reason there is you're borrowing in New Zealand dollars, and the New Zealand government can print New Zealand dollars. You're for sure going to get paid back by them.
I think I'm starting to understand why we don't talk about the bond market as much as the share market, because I think it's just a bit more complex for the casual investor, right? And so the volumes must reflect that, right, on the NZDX versus the NZX.
Yeah, that is right. It is complicated. I mean, I'm a firm believer any single sort of topic in finance isn't complicated. It's only when you think about the exceptions and you go, oh, okay, so to account for that, we do this. And then you combine that with your original assessment. And then all of a sudden you're looking at a bit of a murky pool. But at its heart, bonds are just lending money. And there are lots of people who need to borrow money for really solid reasons. My point is the bond market's very large. Most of the time it's pretty boring and you get paid more for taking a little bit of extra risk. But most of the time, we're sort of the quiet guys in the corner.
Are you expecting that the bond market will go back to being a bit boring soon, or hoping?
Yeah, I expect so. When the chances of recession start to get priced in, the bond market does tend to get a bit more attention than average. So we may see that for the remainder of the year. Certain economists are now day-to-day changing their likelihood of recession based on the day-to-day headlines coming out of the White House. But the chances of recession do look higher now than they did a month ago. And so maybe, unfortunately, bond markets will be a little bit more in the spotlight than normal.
So is the bond market one of the omens you would look at to be like, what are the chances of a recession?
Yes, is the short answer. And so sometimes you might see a news article or a participant saying that the likelihood of a recession is priced at 33%. The bond market is one of the key markets that they would use to sort of derive that calculation.
So next time we see a headline about what US Treasuries are doing, we will have a little bit more of an idea of what it means. Thank you so much for explaining. One of the best explanations I've heard of the bond market. So thank you for your time.
Oh, thanks. Great to chat.
Thanks for listening to The Prosperity Project. You can follow this podcast on iHeartRadio or wherever you get your podcasts, and please do chuck us a rating or a review while you're there. For more personal finance and business content, head to nzherald.co.nz, and please do feel free to get in touch with your questions and your stories, nadine.higgins@nzme.co.nz. A reminder, though, that this podcast is informational only and nothing we say here should be considered personalised financial advice. But also remember that while listening to this podcast is hopefully going to be additive to your financial knowledge, and that is fantastic, knowing stuff doesn't create change. Doing stuff does. So what action are you going to take today to make your life more prosperous? My producer for this episode is Ethan Sills. Sound engineer is Richard Martin. I'm Nadine Higgins. Thanks for listening to The Prosperity Project.